Good morning, ladies and gentlemen, and welcome to the ROCKWOOD Strategic PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following polls, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to Fund Manager Richard Staveley. Good morning, sir.
Good morning, good to see you, and thank you everybody for joining the presentation today. It's exciting times, concerning for many, but a very interesting time to be presenting an investment strategy that focuses on the UK. I've just been writing the kind of fact sheet, which will be up on our website later today, and the number of sort of extremes we've got is just quite amazing. So unemployment at 3.6%, the lowest since 1974. We've got inflation at hit 10.1%, the highest since 82. Last week, apparently, of the top 5 largest moves in gilts, in daily moves in gilts in the last 300 years, 3 of them were last week. AIM market is down 33% year to date. FTSE Small a bit less, and we've just had clearly a lot of political turmoil. So that's an incredible backdrop for a value-based and focused investment approach. And what I'd like to do is take you through the slides that we've got as rapidly as I can, so as not to send you all off to sleep. And then we can get into some Q&A and discuss some of the stocks and maybe the wider environment. So there's the disclaimer. You can look at that at your leisure. So the summary. So what is ROCKWOOD Strategic trying to do? We're trying to maximize and compound wealth long-term for shareholders. We're targeting the inefficient microcap UK market, and we've got significant specialist experience in the team, in our advisory group, and in the wider Harwood network. That network gives us a private markets perspective. Harwood has private debt teams. It's on its 6th private equity fund over many years, and a number of other specialist equity mandates. And we can access all of that to support this approach. We deliver 15%, or we intend to deliver 15% IRR investments. It's an absolute return mindset, not a relative benchmark kind of approach. And we take typically 3 to 5 year investment time horizons for our underlying investments. I'm 100% focused on this strategy. Many fund managers have a variety of responsibilities, but I'm fully focused on ROCKWOOD and very aligned as a fund manager, both in the structure of our fees, but also personally with a significant investment in the strategy. So what is the investment opportunity? Well, hopefully some of you will be completing the polls, but for those that aren't aware, UK small companies are a fantastic long-term driver of returns. It's a structurally inefficient part of the UK market due to the lack of research and also the departure of lots of fund managers from the space as they've become far more concentrated over the years. And as a result, there's the opportunity to find inefficient pricing of stocks. The universe remains significant. At its max, it's about 1,000 stocks, although the actual practical universe for us is probably about half of that, and we track a smaller proportion of that. And what are these companies? Well, they're often what we like to call, hidden gems, maybe quite small businesses that are niche, will never become big, but just aren't big enough for because of their end markets. Fallen angels, so stocks that have companies that have were darlings but have gone completely wrong for whatever reason, end markets or structural change. Lost corporates which have just lost their way, maybe due to complacency, and also family businesses, which are ones which may have joined the market where it's got to a point of generational change. We have a value and recovery mindset, which we believe is highly differentiated from most other practitioners in the UK microcap and small cap space, who have a strong bias to growth investing. We think there's less competition for these style of investments, and that makes us clearly differentiated. We try and mitigate the risks of our approach by doing material due diligence. We have a concentrated portfolio, which allows us to spend a lot more time than the average small cap manager on each holding. And we believe that by doing this research, it creates an information advantage over the rest of the market. And we also have an engaged approach, which we believe enhances investment outcomes. What does engaged mean? Well, it's not hard activism in the style of how the newspapers like it, but more a constructive approach and a very interactive approach with not just the management team, but all members of the board, other stakeholders, other shareholders, and suppliers and customers as well. And we also feel these days there is the opportunity to arbitrage the typical time horizons that many investors have, which we believe are far too short, and allow ourselves to take a longer term view through Rockwood Strategic, which is a closed-end investment vehicle, unlike most small company funds, which are open-ended in structure and thus have to offer liquidity on a daily basis to their underlying investors. I've got a couple of examples on the map on the right. Universe Group. I just wanted to use this as a good example of the inefficiency in markets. In early 2021, I was able to buy a few percent of that business at 3.25p per share. Within 2 or 3 months, it was trading at about 5 or 6p a share, and a bid came in for Universe Group at 12p a share later in the year. A material misunderstanding of the value of Universe, which was in plain sight, but just its size of company was ignored by all. And National World, which is a media company run by a chap called David Montgomery, where again our value and recovery mindset was differentiated. We were able to invest in that when it bought the old Johnston Press assets out of administration for an absolute song, and we were able to back that and relatively quickly make a high return. So our philosophy is simple. We're, as Seth Klarman's quote suggests above, we look for a margin of safety. We're free cash flow focused in terms of how we the types of businesses we want. We want proven businesses with hopefully identifiable assets. We're seeking to find catalysts for change, and we'll then engage with all the stakeholders to try and de-risk our investment and indeed work out what needs to change in order to deliver mean reversion. At the outset, we try and work out what is the mean reversion of profitability that's now depressed? What can it get back to? What recovery in the balance sheet position is required? And equally, what would be a fair re-rating for the business? And very importantly, at the outset, we develop an exit thesis. I mean, obviously, we can't be sure about this at the start. But the point is, we spend time looking at private equity interest in the sector, and even the individual company that they might have, the types of businesses that private equity are consolidating. We do a full analysis of the potential trade buyers for businesses, so that we can have a view that it may be that the stock market is the location where we sell our holding into when we believe we've got to fair value. And often that can be the case because the momentum's strong, and other investors are happy now the business is rehabilitated. But more often than not, maybe 60 to 70% of the time, we would expect the business to be taken over or taken private. How does this happen in practice? Well, if we move from left to right, often the businesses have taken a strategic error. Be no surprise to anyone. Poor merger or acquisition activity, the source of many a problem company. Often management may get complacent or tired, and sometimes it's just very poor operational execution. RPS was a business that identified actually a few years ago in this position, where the CEO had been in place for nearly 30 years. He had a pretty useless or unengaged board, most of which had been on the board for far too long, and he'd undertaken significant amounts of M&A to juice up the perceived growth rates of the business, and as a result got the balance sheet over leveraged. The last few years has seen a complete change in the board, complete change in the management team, and the beginnings of a turnaround in operational effectiveness at RPS. It's currently in a bidding war. MC Saatchi is another holding. It currently in the fund, and here what these issues on the left lead to is clearly a depressed valuation, usually financial stress. Not always the case. With MC Saatchi, they got themselves into a pickle with offering essentially stock to the divisional heads and entrepreneurs within the MC Saatchi network, and that was becoming increasingly dilutive, potentially for shareholders. The MC Saatchi also actually had a counting scandal, and the founders of the business from yesteryear had been there a very, very long time. The narrative, the story as such was very poor, was very negative, and shareholders were clearly very emotional. That again laid up the opportunity to establish that actually the MC Saatchi is a very good business, highly cash generative, and and has significant recovery potential as change comes through. Crestcheck I have underneath the next bubble, as you can see. So what we do is we then essentially establish what the value creation or realization strategy should be. This often includes, but not every time, a replacement or an enhancement of either the board or the management. Often these changes are overdue or may even be happening at the point of entry already. We'll seek to understand and feedback on the operational plan and establish what target returns the business should be able to make. Often we'll be involved then, our position will be taken as we stabilize the balance sheet, which usually is a bit distressed at the time we're getting involved. And at the far end of the process, after all of that's come through, typically 3 to 5 years later, the returns are on an improving track, either fully improved or directionally going the right way. The narrative has been refreshed. People understand what the company's strategy and approach is going to be going forward. The rating has started to normalize again, and then we exit. The most successful investment that has happened at Rockwood was a waste business, a hazardous waste business called Augean, where we made multiples of our money. We actually had over 6% of the company when it was taken over last year. However, Harwood itself, in its other funds, owned 29.9% of the company. And Christopher Mills, who's on our advisory board, was on the board of Augean and helped curate that turnaround and that plan and that value creation strategy, and drove that through to an amazing outcome for shareholders, Our process then is very simple. I'll whip through this as quickly as possible. We screen the market using simplistic screens for valuation metrics, and also to establish depressed profitability relative to historic profitability of businesses. We also have a very wide network in the stock market, and advisors will come to us with ideas. Often actually even board members and former executives will come to us with businesses they think they could get involved with or may need help. We then perform our initial due diligence, which is deep, and we will establish whether there's a genuine turnaround recovery opportunity. If there is, this will result in either two things. We will look to potentially take it forward to even deeper analysis, where we involve the investment advisory group, which has 6 members on it with combined 200 years of investing in financial markets experience. Touch on them and them later. But relatively often, the opportunity to take a massive and significant core investment of between 5 and 15% of ROCKWOOD isn't there immediately. So what we will do is take a springboard or initial investment of between 2 and 4% of ROCKWOOD, where through doing that, we can establish a constructive and working relationship with the board and management, get to know the business better, site visits, additional management meetings, that kind of thing, and with a view to taking a much larger position if and when the opportunity arrives. Sometimes those springboard investments just perform very strongly before we've had the opportunity, in which case we'll just exit because of our value discipline. And sometimes we will just be opportunistic in line with our philosophy, where we think all the work's being done maybe by another shareholder or another actor, or even the existing management and board, but the stock market is not appreciating that change is underway, maybe because it still thinks it won't come in within the next 2 to 3 years, and will take a smaller investment in that case. After we've taken a core investment, almost always through some form of equity raise or through a block trade with an exiting shareholder that doesn't want to stick with the situation, we will start engaging with other stakeholders and start looking at how to take the business forward. And after we've invested, we'll be monitoring it through ongoing engagement through the industry results. So the policy, we've touched on this, but it's UK small company investments. The majority of the capital will be in the top 10 holdings. So at the moment, it's 66%. And those ones are typically under 100 million market cap. The rest of the capital in springboards, and we will be, and we seek these influential equity stakes. We typically target at least 5%. That gives us EGM rights. We've never actually had to forcibly announce an EGM yet, but companies know that once you're at 5%, you have to be taken very, very, very seriously. But often we'll have a lot more than that. And it should be noted, we can take up to 15% of the portfolio in private companies or instruments. However, this isn't a la Woodford or those kind of approaches. These are twofold. We're looking to potentially, we may complement an equity exposure with a loan or a debt style instrument that converts into equity, which just suits the capital structure of the business that we're investing in. And also in the future, it may be some of our holdings are taken private, and we want the flexibility to stick with the business if we feel that maybe the vote's gone through, but the business is still highly undervalued. But we'll limit that to 15%. So this is the portfolio as of, I had to rapidly update this in the last 24 hours for last Friday's closes. So you can see these are the core holdings. and this huge position in Crestcheck, which I'll talk about shortly, at 28% of the portfolio. To be clear, the last company that we had at this level of weighting was Augean, which went on to be bid for at a very significant premium to the price that we were holding it with. And prior to that was a business called IMI Mobile, which also went on to great success and was also taken over eventually. You can see the level of stakes that we have in the core positions in the second column, and also the very low valuations on our estimates, current estimates of EBITDA for 2023. And the market cap's all under 100. I'll talk about of these, and can do in the Q&A. That's just a feel for those at this point. The Springboard and Opportunity Holdings are these companies. You can see MC Saatchi's one that's gone very well for us. We started buying in the 50p's. We averaged at about 80p. It's currently ludicrously undervalued at the current share price due to a technical situation with the bids that have come in for the business, opportunistic bids as they are. And you can see we've added a number of new holdings during 2022. Candidly, it's been a year where almost anything one has bought this year has been difficult to be in the black on. However, stocks like our Gentex have been performing well so far. RM is the most recent investment, and I will talk a little bit about that shortly. You'll see here that the stakes are on the whole smaller, but you can see we have taken 5% stakes in 3 of these businesses already. So that's a portfolio then of 15 holdings across sectors, different types of businesses. All of them have significant scope for profit growth. And I think in the context of this year, it's worth highlighting that these EV/EBITDAs are on profits where we know that self-help and just better operational delivery should be able to grow the EBITDA kind of irrespective of the economic backdrop. You can take any of these we can talk about in a moment. So Crestcheck, I'm going to talk about this because if you buy some Rockwood strategic shares, you get a big stake in you have big exposure to Crestcheck. We have Nick Mills, who's on the investment team, is a non-executive director of Crestcheck, and we propose Stephen Yap join the board of Crestcheck about just over 12 months ago, maybe 18 months ago now as well. We have a large stake, as I showed you in the previous chart. However, I'd add that Harwood funds in other strategies have also purchased stock in the last 12 to 15 months, and Harwood as a whole owns 24% of the business. What does it do? It manufactures and rents load banks, which are used for testing the reliability of electrical connections and generators in a range of industrial contexts. Its end markets are such as hospitals who have backup power, which they have to test to make sure it always works, to data centers, where they have to do a combination of testing the heat conditions and also the electrical backup power. They have the world's largest players in that space, our clients, and also in remote locations where there's temporary generation that needs testing. So, for instance, they've just recently won a large project which is in Kazakhstan for a huge gas development there. The business had depressed returns as a result of a poor diversification into a division focused on the oil and gas arena called Tasman. The business hasn't made any money for the last 4 years or so. We identified this was depressing returns and was unlikely to achieve any significant shareholder value in the medium to longer term. So we pushed is probably the wrong word. We encouraged the board to let Stephen Yap join. We then discussed what the strategy should be, and the strategy was to focus back purely onto Crestcheck, sell the Tasman business, and focus on return on invested capital, which they hadn't done explicitly in historically. The business has now done fantastically well. They've executed on the sale of the division, and profits have really come through. Returns on capital have been up. They've just expanded their factory materially. Initially, they hoped by 50 to 60% in terms of capacity addition, but they're expecting that to be more now. And the order book is absolutely full. You can see on the right that we now have EBITDA expectations of 12 for this year and 13 for next, which I'd expect to be very conservative. The order book being as strong as it is. The balance sheet's in great shape. We actually used to have a bond into the business, which we converted partly into equity. And we would expect this business and similar businesses, private equity, would pay about 10 times EBITDA. So as you can see, despite Crestcheck being an absolutely storming performer in 2022, we still think there is significant upside for this investment, and we are sure going to drive ROCKWOOD strategic returns over the next couple of years. Centaur Media, our IRR to date, much lower at 4%. We bought a lot of stock during 2020 and early 2021. It's a media business, B2B media business that's targeting 23 EBITDA margins in 2023. To put it in context, they were making losses and very low single-digit margins only three years ago. I'm personally on the board as a non-executive director. The current management team have been involved in the turnaround of this business in the last 3 years and have been driving profitability significantly forward. It's got 2 divisions. One of them is focused on the law industry. They own The Lawyer, which is an unbelievable brand. And if any listeners know a lawyer, they'll tell you they take it. Subscriptions are running well over 100% currently, and that business is highly profitable and a unique property for them. Their other division is in marketing services and sort of training and consultancy around the marketing industry. They have a number of brands. It's a very interesting ecosystem. They own an amazing industry show called Festival of Marketing, which is actually happening this week on Thursday at the brewery in Chisel Street in the city, and it's completely sold out. They have a e-learning business called Mini MBA, which both corporates pay for their employees to do, and is a fully accredited MBA in marketing, and which individuals pay to increase and improve their skills and improve their CVs. They own Marketing Week, which is the main rag, now fully digital, in the marketing industry. And they have a business called e-consultancy, which consults and helps businesses from Unilever through to a range of other blue chip brands how to digitalize their marketing activities. It's an amazing business. You can see on the far right that it has huge amounts of cash. We're estimating by next year they'll be up to 20 million. It's less than that now, but a very significant amount of cash on the balance sheet, 14 million. You can see we see EBITDA I see EBITDA as continuing to improve. You can see strong growth there, and again, driven by margin improvement. And we see this again as being a highly valuable business with a very high premium content and highly cash generative business. Huge upside from our perspective. I'm not going to go through all of these, but I will mention a couple. I'll mention quickly RM Education, just because it's the most recent thing we've been buying. Anyone that looks at RM's share price graph or reads the most recent results will find it uncomfortable to read. RM has actually been around for many years and has had a highly profitable business selling supplies into primary and secondary schools in the UK. Actually sells products to 90% of all primary schools in the UK, from the very basics such as crayons through to highly complicated and bespoke learning tools for primary schools that are curriculum driven. It also is a leader in exam marking, which it calls assessment, where it marks the International Baccalaureate in this country. It marks the ICAEW Chartered Accountancy exams. It marks lots of A-levels and university exams as well. It's a very profitable business that they have there. They have a third division where they're seeking to grow more into the managed IT services into schools. And this year, what's happened is that the management team have essentially botched an internal IT project to roll out an ERP system across the whole group, all three divisions, and at the same time consolidate down the warehouses down to one key warehouse. Both projects make complete sense. It's the execution that's caused the problem. This has put the business at stress financially, so the debt, it's moved into a significant debt position. However, we think that the banks are supportive, and we also believe the core online businesses will generate significant amounts of cash in the future. Our sum of the parts valuation is significantly in excess of the current market cap. And to go back to the whole point of Rockwood, this business has been around for many years. I think at peak it was worth well over 200 million market cap. The start of this year is about 100. The profit warning and market environment had them down to about 50 million only a month or so ago. And a small cap manager with a large fund has dumped all his stock into the market at a huge discount. And we've been picking this business at a market capitalization of 25 million pounds. Market forecasts, which are likely to still be, given the trend, is likely to still be possibly optimistic, but post the last profit warning, expect the company to do 22 million of profit. So we are getting our sleeves rolled up with that at the moment. On the next page, I'll mention on Gentex, because it had a trading statement yesterday that we were delighted to see. It's an FX services business, and we can all see from the news wires that FX has been an area of lots of volatility during this year. That said, that's not why we bought our Gentex. We bought it because they were a growth stock with unrealistic IPO expectations, who have missed their numbers, and as a result were derated. The co-founder exited, which caused a bit of destabilization in the business, but they've now readdressed that. There's a new head of technology, which they're improving and investing in for the business. It's not one of those sort of consumer-based FX translation businesses. It's focused on corporates who have requirements to hedge their FX needs for their business requirements. But who are genuinely getting very upset with the quality of service and the charging of the very big banks. So they're gradually taking share from them. There's a comparator called Alpha FX, which is almost identical to our Gentex. It's got roughly double the number of employees of our Gentex, has roughly double the level of sales of our Gentex, and it has a bit more than double the profit. It's got better margins, and that's an opportunity from our Gentex as it gets bigger with more scale. However, Alpha FX's valuation is many multiples of the Argentex valuation, and we see that arbitrage is something that will narrow over the next couple of years. I'm just going to whip through some quick bits on small cap in case there are people that haven't looked at small company funds before. But when markets are very depressed at the moment and sentiment's very poor, it's easy to forget the long-term opportunities. The NSC 1000 bar on the far right is the bottom 1,000 companies in the London stock market, showing you that small basically generates the longest long-term returns. The next one is another small cap indices, but just not quite the very smallest. We see this trend as continuing long-term, and in fact, as this performance is a very long series, you'll get obviously periods of underperformance and outperformance relative to this trend. It would be typically from a low point here, you may get actually better returns over the nearer term, would be our view. You can see that in the UK market valuation here, where the blue dashes are the 30-year average of UK equities. This is a few weeks old, this chart, so I suspect it's even more stark, but you can see under all metrics we're well below the 30-year average. And on the right, you can see that we're clearly also significantly less cheaper than the rest of the world. That's just graphically representing. This is up to last Friday. Actually, I managed to get the latest here. And Peel Hunt, where this source were coming from, were telling us that it's the first time since actually 2008 that the all shares down to nine times. Performance of Rockwood. This is updated for the end of the quarter as of Friday. You can see the shares have been holding up well. We've got very supportive and long-term shareholders who understand how this portfolio is going to behave over the next couple of years. And the NAV, though, it's fair to say, become increasingly more difficult to deliver an absolute return during 2022, given the collateral damage that's going on elsewhere. But you can see we are holding our own significantly against the small cap market. We are actually, as of today, I think the best performing small companies closed-end fund in the last 12 months. That's enough from me. The investment advisory group, and then we'll get to Q&A very, very shortly. Christopher Mills, who founded Harwood, over 40 years of experience, huge experience and insight into both private markets and public equity markets, and a number of other outstanding practitioners in the IAG. Adam Parker, one of the founders of Majetti Asset Management, Jamie Brooke, with a huge history in strategic investing, Rupert Dyson, a extremely good investor and founder of Edale Capital. He's a hedge fund manager, but participates in UK small caps and understands our part of the market well. Yuri Kojamirian, who is a global investor and extremely bright individual, and David Potter, who has a hugely long career in financial services, has seen many a cycle, maybe even more than Christopher, and has seen how businesses perform through that. Closing up now, I mentioned at the start, skin in the game. Christopher from the IAG and myself have purchased personally 29.9% of Rockwood Strategic. We want this to be a long-term project of delivering significant value to us and the rest of the shareholders. We've made it economic for everybody, given the size of the fund at 37 million currently, whereby we're only charging £120,000 flat fee, whilst the NAV is less than 60 million. You can probably work out that is not in itself covering the costs of running this for Harwood. We'll migrate to 1%, which is far more normal for these style portfolios once we get to 60 million. And we have a performance fee which requires a 6% absolute hurdle, and then we charge 10% of the outperformance over that. We moved to the main market last week, which we hoping to broaden appeal and makes us fully tax efficient. That's the shareholders, don't need to do that. So I think that's basically wrapping up now, and we can go to Q&A. If you give me a moment.
Sorry, Richard, that's great. And if I may just give you a moment there, thank you very much indeed for your presentation this morning. And if I may, I will just bring back up your camera. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while Richard takes a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Richard, we did receive a number of pre-submitted questions ahead of today's event, as well as you can see in the Q&A tab, a number of questions that have also been submitted throughout today's presentation itself. So firstly, thank you to all of those on the call for taking the time to submit their questions. And Richard, if I could just hand back to you to run through the Q&A tab and respond to those questions where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Great. Thanks very much. Just highlight, this is the first time I've been on Investor Company. It's a fantastic platform, but you might have to bear a little bit with me. So I can see we've, right, here, there's one question here. How involved do you and the advisory group actually get with investments? Is the thesis of making a new investment to actually change it? So the way the advisory group works is that prior to taking a very significant position within Rockwood, so from 5% to say 15% of the portfolio, we want to make sure that the due diligence and thought process into making such a significant investment is being thoroughly tested. So at that stage, during that second stage of due diligence, we interact with the IAG members, and what they may do is they will either they may know board members on the pipeline company. They may know the actual management team. They may have had experiences with them before. It's possible they actually have invested in the business before, may have insights into that or the sector. They're all highly experienced investors in their own right, so they will have concerns or areas that they think we should spend more time on as part of the due diligence process. So it's a kind of interactive process with them to try and enhance our DD and minimize the chances of that we're doing something ridiculous. Some investment processes have a gating where they're more like a committee, which has to sort of say yes or no. We don't believe in committees. We think it's a dangerous thing. But we do believe in challenging ourselves. So once the full end report, which can often be, I think the longest I've ever written was 50 pages, which is almost too much for everybody. They will feedback how they feel about it, and we may mitigate or change the nature of the deal or transaction, the size of the position as a result. In terms of the second part of that question about are we looking to actively change it, I guess the most important thing, what we're trying to do is actually just make lots of money for our investment. We are looking for situations which are undergoing change, and it may be that so we're looking that the board and the company may already have their strategy for change in place, or it may be being evolved at that moment. But it might be that they require more money because they're distressed. So we will then get involved by helping to maybe cornerstone the refinancing to then involve. Now, others, we may can take a large stake, and then we are actually the catalyst ourselves, and we're seeking to be the catalyst for change and get that process going. And in that context, we'll do everything from introducing investor relations and those kind of advisors, changing the actual brokers, evolving the board to people who might have better experience at turnarounds or more focused on shareholder value. It may be we introduce a new finance director because the previous one isn't up to scratch. It's that kind of thing. Okay, there's a couple of questions on Pressure Technologies, so I'm not going to duck that situation. Could you comment on the situation at Pressure Technologies? The share price has collapsed recently following a delay in orders and consequently likely covenant breach. Are you still supportive of the company and its management? How do you see the situation playing out? Following up on Pressure Technologies, are you expecting a capital raise? So I have to be careful about how I speak about this. So it's 2.8% of Rockwood now after the recent share price move. It's the amount of capital we have exposed, and we own about 13.4% of the company. It's been in the portfolio since early 2019. And the business has, and the CEO there was brought in to start the process of sorting it out, which is definitively taking far longer than everyone expected. Pressure Technologies has two divisions. I'll take the weaker one first. Has a business called that's known as PMC, which stands for Precision Machined Components. That business is heavily exposed to the oil industry, where it machines components for the oil industry with very, very significant the household names in oil services like Baker Hughes and Schlumberger and Halliburton as clients. Trading there has been poor for a number of years, but actually it is definitively on the up. Apart from the fact they did actually have a lull this summer, which is one of the reasons why the company has recently disappointed. Our understanding is that's actually re-accelerated since, and PMC is a business that's moving into EBITDA positive situation. That said, it would be our view that business would be better off owned by others, and we think that business should be non-core. The primary business is called Chesterfield Cylinders, where they are one of only literally 3 players globally that make high-spec pressurized cylinders. These cylinders, think scuba tanks, if you're not sure what I'm talking about, but they don't make scuba tanks. They make things that look like scuba tanks, but they're the size of a Ford Fiesta, that go in the front of our new nuclear submarines, for instance, where they have huge contracts with BAE, and also the French Navy, and they also make these types of containers for BOC and a range of other people. The business is very lumpy, and they've had a lumpiness hurt them this summer. And they have also been developing new markets in hydrogen, where these cylinders may be one of only a tiny selection of opportunities to support the hydrogen economy with regards to refueling stations where the hydrogen would need to be stored. And the hydrogen sales are growing and could be very, very material. So the question is, I'm not teaching is, the question is, are you still supportive of the company and its management? I do believe that Chris Walters, the CEO, who has been under-resourced until relatively recently, there has been a new CEO appointed, is has got the credentials to take this forward. I am disappointed about their miss of forecasts, though. And we are heavily engaged. The fact sheet went out today, and the statement I said was we are heavily engaged with them. The shares have been very, very hard hit. So the market cap's about £9 million. They own their 100,000 square foot freehold facility up in Sheffield themselves. And the Chesterfield business has been around for 100 years, has a large order book with blue chip customers, and actually sells a product which is essentially a national security issue. It strikes me there is a business here. It does strike me, like many small caps, that it remains difficult to essentially handle the lumpiness of their business of this size with their requirements as a publicly listed vehicle. Hopefully that's answered you to as best I can. Liquidity risk. How do you manage this practically? Do you limit position size and any discount to NAV mechanisms? Okay, so that's twofold. I think that's one about Rockwood and one about our investments. So with regards to liquidity, we kind of embrace it. So the key with liquidity is that illiquidity creates a discount, which is essentially, you can pick that up in terms of outperformance if you embrace it. Because we're a closed-end fund, we're never going to be forced out of our illiquid positions. But equally, we definitely don't want to be stuck in what I call a lobster pot, where we just can't get out. We've made a mistake. So how we mitigate the liquidity position is through having a very significant stake, and then our engaged approach alongside that, where we may work with other stakeholders and via that stake to make sure that shareholder value is realized. So where things go difficult, like with Crestcheck, it's a situation where we can roll up our sleeves, get involved, and make sure that the right decisions are made. We also, there's an element of liquidity management around the springboard size positions in the first instance. So we're not in that situation going all in with a huge percentage of the fund on day one until we've got really comfortable with the underlying company. We don't tend to trade that much though around our positions. We genuinely are taking a 3 to 5 year view. Warren Buffett used to talk about, stock prices. The only ones he cares about are the ones, the price he bought and the price he sold. I would think the same thing about liquidity. I'm only interested in the liquidity situation really when I buy it and get my liquidity at this very undervalued share price, and then ensuring there is an exit liquidity at the end. And in relation to that, someone's also asked, with such large positions, exiting must be tricky. What are your typical exit routes? I wouldn't want to downplay it. Exiting and getting everyone in place to drive an exit is not an easy an outcome, but it is. It often, if everyone's agreed to a certain course of action or generated to a target level of returns, and if it's very clear to all that the stock market is not valuing the business consistently, appropriately, irrespective of performance, 99.9% of boards will know that they need to seek the realization of shareholder value rather than just carry on regardless on public markets, and shareholders typically think the same. So our exit routes are usually either to private equity or to a trade buyer. That said, we do exit to other fund managers, and that happens too. Okay. Does the fund have a low beta to the rest of the market? Well, it definitely looks like it. It definitely looks like it at the moment. The fund is actually flat, or slightly down now, very slightly down year to date. Which, if you looked at our share price graph, you would just not believe what the headlines have been this year. So in that regard, it is low beta. It's not in it. Theoretically, it shouldn't be lower beta. It's absolutely driven by the underlying stock behaviors. So Crestcheck's been fantastic, and we've had solid performances from a few other holdings, which have held the NAV up well relative to the disappointments or just general weakness across other holdings. Someone's asked, how do you plan to grow the fund? So we are quite small, although we've got the costs materially down due to the management fee, and we've also did a full review at Harwood of all the cost providers to make sure that we're not over, the expenses aren't too high. And given that Christopher and I have got 29.9% of it, we want to make sure the costs are very sensible. How we'd like to grow is through the following. We need to drive the discount in to par, i.e. to NAV. It's currently 2.2%. It's narrowed in recent times. And once we get to par, we would like the opportunity to issue new stock to new investors, and indeed ourselves. We would put more money in at that point ourselves as well, and that's how we intend to grow it. We've appointed new brokers this year, Singer Capital Markets, who are introducing us to loads of new investors. The roadshow started yesterday, and I'm off all over the country next week. We hope that will start some conversations. We don't aim, though, to grow it too fast. So we don't want to have too much money to invest in a short period of time. So we're seeking to do incremental issuance to support new investments. Can you please outline your investment thoughts behind your Flowtech holding and what a realistic fair value might be for the business? So Flowtech, fluid power, is one of the core positions. It's a distribution business of hydraulic and pneumatic components. About 60% of the components are or of the sales are into repair and maintenance type decisions. So they, absolutely have to reorder a new one. And like any distributor, the opportunity for Flowtech is to provide outstanding service to its clients, have the right range, have the right stock in stock, so they can deliver it quickly to their customers, and then essentially, like all distributors, arbitrage the better buying power they have with the ultimate end manufacturers, and turn a margin into by selling it on to their own customers. The best distributors turn their stock very, very quickly, and Flowtech is not turning its stock quick enough. In fact, its stock has increased this year rather than speeded up, and in terms of its turn has increased this year rather than has lowered rather than increased. Sorry, I can confuse myself now. Flowtech's has a stated target for its stock turn, which is materially above where it is, which they call the turn and earn ratio. It's in the financial accounts. You'll see that. And if they were to deliver that level of turn and earn, the business would be generating materially more EBITDA than it's forecast to currently generate. Its margins are about 8%, but we believe it should be making at least 11% operating margins. Some would argue should be more than that. And the business has been through a phase where it's had to integrate much better some of the acquisitions that it's made in that distribution space to create bigger scale. They've launched finally an e-commerce platform this year. It's it was slow and late, and the risk really should have been in place earlier. But we are literally moving from the age of catalogs in the repair shop through to sophisticated e-commerce ordering, which should provide them with opportunities to improve efficiency and indeed better service. We think that if you look at private equity transactions in the distribution space, there's been lots and lots. There used to be quite a few distributors in the UK listed on the UK. They've all have gone private. There was even rumours earlier this year that Brammer, one of them, would come back to market. But there's huge distribution businesses owned by private equity and otherwise across Europe, and kind of 10 times EBITDA is, there's a range around that, but would be a reasonable target for the level of EBITDA for that holding. We own a decent amount in Rockwood. Harwood, other funds have more, and Edesian, which is 50% owned by Harwood, also has a stake. So overall, if you add up all of those, there's about 25% ownership within kind of Harwood and Harwood-related vehicles. Jamie Brooke recently joined the board, who is, as I described earlier, is on our investment advisory group. So we have good, we're able to have a good line of communication with Jamie and into the company. And Roger McDowell was announced as chairman last year. I touched on Augean earlier in the presentation, where we made many multiples of our return, and Roger is a proven moneymaker. His actual initial early on in his career, one of his big business was actually a distribution business. So he's really back to his roots here with Flowtech, and we see that as very positive. So we're comfortable that they should have lots of opportunity to reduce the stock in the business, speed up the stock turn, drive up the margins, increase the EBITDA. And then they have two options as a business. They can either get on the front foot and start consolidating again, or they can seek to get full value from one of the larger distribution groups. Okay. With the trust now listing on the main market, I expect that the fund looks to increase its AUM to above 60 million. What impact will this have on performance going forward, seeing how it may limit the fund's ability to invest in the smallest small companies? Well, we're definitely the only fund this sort of question can be asked at the moment, as one of the smallest in the market. I have no concerns whatsoever about us being able to continue to drive returns at a size of 60 million or 100 million, or in fact even 200 million. We're very comfortable that the fund could be up to 200, 250 million without any impact on our ability to use this approach within market caps under 250. If we take, for instance, a £100 million fund, which would be tripling from here, the £100 million fund, if we take, say, a big position, let's say of 10%, would be a £10 million position, which could be 10% of a £100 million company. Would be the largest shareholder with significant influence. The mainstream large cap, small company funds are just not going below 200 now. They just don't. And in this market, there's just no way they're going to. They're focused on £1 billion funds. So maybe the very, very smallest, so the 10 millions or the 15 millions won't. But actually, if we get bigger, it will open up our universe of ones where we can make sure we have influence still in that sweet spot below 200. I think we're on time now, Jake. I'm just thinking.
Richard, absolutely. And thank you very much indeed for addressing all of those questions that came in from investors this morning. And of course, if there are any further questions that are submitted today, we'll make these available to you immediately after the presentation has ended for you to review and then add any additional responses where it's appropriate to do so. Richard, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Sure, thank you, Jake. Well, thanks everybody that's been listening in today. We don't have many opportunities to promote Rockwood. We're just starting on that journey, really. You can see what the performance has been like. We are very excited about the portfolio in the medium term. We've positioned ourselves with strong influence in these businesses that we think have lots of opportunity for upside and re-rating. It's clearly a very differentiated strategy. I would urge you to, for those that are thinking the same thing, to not go down the route of trying to pick which ones from our portfolio you think are best, but just allow us to just manage these positions over the medium term. We think it will do you well, and we'll be able to grow Rockwood going forward. And thank you just so much for listening in and all your questions.
Richard, that's great. And thank you once again for taking the time to update investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. It's going to take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Rockwood Strategic PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.